Now, the big jump that we saw in oil prices in the immediate aftermath of the tensions in Israel have started to pull back a little bit. Of course, the market is digesting the fallout from Hamas's surprise attack on Israel over the weekend. At least 1,500 people have died so far as the conflict in Israel and Palestine, which has the potential for far wider geopolitical ramifications, now enters its fourth day. For an understanding of what this means for the oil markets, let's bring in Ed Morse. He's global head of commodity research at Citi, and he joins us now. Ed, this is a very narrow way to discuss the fighting that continues to rage on, but it is perhaps the most immediate place that we saw markets react, this big spike in oil prices. Walk us through how we should be thinking about this.
So I think the big spike that we saw was not such a big spike. We had anticipated a spike as a reflection of really increased risk. But as the market is digesting what's happening, that risk is all potential. It's not actual. There's no indication that oil supply anywhere in the world is as yet under any kind of attack or vulnerable. But there is obviously a higher probability than there was a week ago when prices were falling significantly and at a very rapid, unexpected rate. There's a higher risk of an interruption somewhere. But when we think about that interruption, it might be Saudi Arabia not cutting, as people thought in some headlines last Friday, that as a result of a new deal to recognize Israel, to get nuclear activity going and a deal with the U.S., we thought that might happen, but that looks now less likely. And now we have a potential of somebody trying to tighten the squeeze on Iran, depending on where the evidence goes on Iranian background to the Hamas attack. But there's no real change in the physical market at the moment. It's all hypothetical. It's all scenario based. And we've seen that financial flows have not really come back strongly in the market. Otherwise, we'd see not only a higher price, but we would have seen a continuation of yesterday's knee-jerk reaction increase happening today, and it's not. It's fallen off.
You've mentioned two flashpoints. One is Iran, what happens there to the extent that they are overtly blamed for fueling Hamas. The other is this reset of diplomatic ties between the U.S. and Saudi Arabia that now looks to be in peril. Both of those risks, though, Ed, look skewed to the upside for oil, even though we don't know. Isn't it fair to say, though, that, if the blame falls on Iran, more supply comes out, and with the U.S. and Saudis no longer agreeing, that there, too, you don't get that reprieve in oil prices?
Yes, there is no doubt that there is vulnerability there and there is price risk. So the perception of price risk being raised is quite real, but we haven't seen anything in the market to indicate that what we consider to be a bearish fourth quarter and an even more bearish 2024 is going to turn around in any way that's significant. We just see more supply coming into the market, and we see demand languishing because of things that you just talked about, including the IMF reducing its expectations of growth, the World Bank a week ago seeing Asian, non-OECD, non-China growth flattening out more significantly than they did before. So the market forces at work with a recession in Europe, a potential recession in the United States, and China not showing any signs of significant bazooka effect of new fiscal and monetary policy priming the economy. Without those, we're not going to see high demand, and we have more than enough supply in our judgment coming into the market from non-OPEC countries and some OPEC countries that we used to think were going to be, losing supply rather than gaining them. But if you look at Iran, Iraq, Libya, Nigeria, Venezuela, the likelihood is more that they're going to surprise on the upside rather than on the downside, with that potential exception of Iran, which saw a big run up in production year to date. We expected a continuation of that, and that's now certainly in jeopardy.
Okay, but didn't we walk into January of this year expecting all of those things, a slowdown in the economy? China's recovery was lackluster. And against that backdrop, we saw demand hold in some places it was a record, and supply remained tight. What gives you the confidence that all of those things that we thought were going to happen in 2023 now going to happen in 2024?
Well, first of all, we think that that's an exaggeration of what's happened in 2023. We think, demand in the way we measured it is not yet reached pre-pandemic levels, let alone new records. And yeah, of course, there are new records in some countries like India that have been growing, but demand for gasoline is lower than it was even in the United States. We had now, in retrospect, virtually no summer incremental demand season for gasoline. Mm-hmm. So I think that the impact possibly of prices, but most likely for structural reasons, has not been what we expected in demand. And I'll point out that we had inventory builds at the beginning of the year. OPEC didn't expect them. They were worried as prices went to the low 70s with that inventory build that we were going to have a free fall in prices. They took some voluntary cuts in May, didn't affect the price very much. It wasn't until the summer cuts that were taken by a combination of Saudi Arabia and Russia over and above the 2 million of cuts that OPEC was already taking, or OPEC Plus were already taking, that we saw finally an inventory draw. And that inventory draw looks like it ended in the month of August, and preliminary numbers, high-frequency data for the month of September, are showing an increase of oil on the water and an increase in oil inventory on the land, particularly more so on the product side than on the crude side. And we've seen as a result of that, what were expected to be continued record refinery margins coming off rather dramatically from the end of August until today.
So with that in mind, if that's your view, where do you see oil prices going from here? Remind us your targets.
Well, our target was for prices to be in the low 80 range Brent and the high 70 range WTI for the average of the fourth quarter. And we are thus far not budging from that. Prices have come down faster than we thought they would be coming down, even before the third quarter ended. So the fourth quarter has started closer to where our average target was going to be for the third quarter. And we think that unless OPEC takes action, we'll see prices continuing to go down through all of 2024, with demand being outpaced by supply by about 1.5 million barrels a day.